As an ETF investor, I am one that just does the buy and hold strategy. And in today's video, we're going to be looking at the top 5 ETFs to own now and going into 2025. Now, this is an article that was shared over on MarketBeat, so I want to break this down a little bit. Now, of course, when we think of ETFs or exchange traded funds, it gives you a very easy buy and hold mentality because it gives you exposure to a sector or multiple sectors like the VOO with the S&P 500. It requires very minimal effort, very minimal attention. You can just continue putting money in there, which I do through dollar cost averaging, and you can get a very good return. Even thinking of the S&P 500, it has been a banner year this year, up over 20% already, and we still have another quarter to come. So let's look at these ETFs that they are pointed out from Market Street and see exactly my thought in them. Now, the first one they look at is the VOOG. So this is a supercharged S&P 500 growth. So instead of being in the entire S&P 500, this one only targets 230 of the top growth stocks from the S&P 500. So now not only are you taking those top 500 stocks, but you are segmenting them, in the G part of the VOOG is the growth part of the S&P 500. So they're based on momentum, sales growth, and similar factors to really focus on. So this is an ETF that is getting the best growth of the S&P 500, putting it into one ETF, which has a pretty good reduced cost. While the stocks individually are a little bit more riskier, you are still exposed to 230 of the top growth stocks in the S&P 500 itself, which of course is leaning heavily towards tech. If you know, I am in favor of tech. I think tech investing in the next 5 to 10 years is going to exponentially take a growth as we continue to see really the craziness with artificial intelligence. When we look specifically at this ETF, the VOOG has advanced more than 40% this year. So we are looking almost double of the S&P 500 just based on those big stocks. The second one they look at is RING, or the RING. This is the iShares MSCI Global Gold Miners. This is an indirect exposure to gold. In 2024, shone brightly, gold reached a record high again. Investors' indirectly exposure to gold would be through this RING ETF, broadly diverse fund that has access to gold mining companies in both developing and emerging markets. This, of course, is not one that I'm familiar with, but this would be the way if I wanted to invest gold. I don't want to go out. I don't want to hold gold. I don't want to buy gold bars like we see at Costco. I want to be one that is going to benefit from this side of the market, which I don't have any exposure to. But overall, it has surged over 61% in the last year. So we have seen a massive increase in gold. This ETF is for those that don't physically want to hold the gold, but still want the exposure to it. Now, the third one we look at is the SMH. This is really liquidity or liquid access to semiconductor manufacturers. Now, this one, of course, is focused on artificial intelligence and focused on the semiconductor side of the companies that are making the power behind it itself. This ETF holds 24 manufacturers within a variety of market caps and focuses all its entirety onto semiconductors. So when we think of some of the ETFs that are a little bit more diverse, might cover the IT space, might cover a couple different things, this is kind of laser focused in on just semiconductors and just semiconductor manufacturers, which of course it's neither cheap nor broadly diversified. This is very specific and exposure to that semiconductor space. One of the most moderately priced funds for the semiconductor with the companies that are in here. It does have high liquidity, which is something that people do look at. Now, the fourth one that we look at, and this again is kind of an interesting one, SCHA. This is access to small caps while mitigating risk. Now, this is the Schwab US Small Cap ETF, or the SCHA, companies that have a higher reward, higher possible return, but it does come with a higher risk. They are more established and well-known firms. When we start looking at this ETF, it is a sizable portfolio of nearly 1,800 US listed small cap companies. Now, when it comes to small cap companies, when we start seeing interest rates start lower, a lot of small caps and mid caps do kind of pop off. One by one, there can be a lot of companies because they have the ability to take the risk. They have the ability also to borrow more money. This is a little bit riskier than we see with the large companies, being it a bigger return when you look at it. The fifth one and the final one we look at is the VIG, which is the Vanguard Dividend Appreciation ETF. Now, this is one that I do know a little bit about. Now, when it comes to the Fed cutting rates, we know that bond rates are going to be losing some of the appeal. Some of the money is going to come out of the bond market. Securities that pay dividends will seem more attractive. And this is the flow of money. This is where we see things. Now, this has an exposure of a basket of 180 large cap growth stocks that pay dividends. When you think of the HD, when you think of the dividend paying companies, this fits perfectly into the portfolio. To include, a company must have a history of increasing dividends for 10 consecutive years. So it's pretty lucrative in there. This last metric provides some assurance that companies in the portfolio are going to be stable, not overpaying dividends, and also not only paying dividends, but most of them are increasing the amount of the dividends they're paying. Now, of course, when it comes to ETFs, you have to consider the risk mitigation that they have within there, what exactly it is going to have with the risk, and also what is the expense ratio. ETFs notoriously have a very, very low expense ratio, even thinking of the VOO, which is a 0.03. And honestly, the higher the fee that you have, if you have an investment advisor, if you're putting into mutual funds, the chances are a lot of those gains are going to be eaten up over time. When you think of the 1% that someone might charge, then you exponentially put it out for 30 or 40 years. It can be a crazy amount when you don't look at ETFs. So of course, me personally, I do not buy any individual stocks. I only buy ETFs. If you've checked out some of my videos with my portfolios, that is all that I build. Now, of course, you have to make sure the trade volume is there, noteworthy, because there could be some where if you wanted to sell, you might not be able to with some of the ETFs if they're not actively traded. So definitely do your own research and let me know definitely do your own research. Let me know in the comments what you guys think below, and I'll catch you in the next video.